A reverse mortgage is a type of a loan designed for homeowners who are typically 62 years or older. It allows them to borrow against the equity in their home without having to sell the property or make monthly payments to the lender. Instead, the lender makes payment to the homeowner either as a lump sum, a monthly payment, or a line of credit. Here's how it works. The loan is repaid when the homeowner sells the house, moves out permanently, or passes away. The loan amount is based on the homeowner's age, the value of the home, and the interest rate. The homeowner still owns the home and must continue to pay property taxes, insurance, and maintain the house. In reverse mortgage, the loan balance increases over time because the homeowner isn't making payments and the equity in the home decreases. It's typically used by older adults who need additional income to support their retirement while staying in their homes. When the loan comes due, the home is usually sold and the proceeds are used to pay off the reverse mortgage. If there is any equity left, it goes to the homeowner or their heirs.